I'm about to show you my #1 breakout trading strategy to find explosive stock gains. Now, it follows a very simple, very repeatable pattern that anyone can learn to spot, and it looks like this. Now, I've marked up a couple of things on the chart, which I'm going to walk you through. You see both the shallowing pattern there outlined in white and also the precise moment when you should have bought this stock. Now, this strategy, this pattern is going to do two very important things for you. Number one, it's going to help you buy right as the stock is exploding higher. Most of us don't want to hold stocks during choppy periods or let it go 20, 30% against us before eventually going higher. You really only want to be in during that growth phase, right as the stock is making a big and fast move. Secondly, it's going to greatly reduce your risk. When you learn to do this properly, you should never need to risk more than about 10% on any given stock. Now, this is a chart of NVIDIA. It's a daily chart covering roughly 10 months of price action. So each one of these green bars a day. And as you'll notice, it's formed this kind of shallowing pattern here right before where I've marked it to buy. I've also drawn a horizontal line right about the $50 mark, which was clear resistance for this stock. Resistance being a price the stock is unable to get above. So two things you need to understand and comprehend for this to make the most sense. Number one, it is not us that moves stock prices. I don't care if you have a $50,000 account or a $10 million account. You do not have the buying power to move these $100 billion, in this case, a $4 trillion stock. It is hedge funds, endowment funds, pension funds, exchange-traded funds, mutual funds. The big, giant Wall Street players swinging big weight that moves stocks. Okay, so that's number one. The second thing you need to understand is they cannot and do not buy like you and I. See, one of the biggest advantages you have as a retail trader, a little guy, right, is that you can move in and out of stocks very quickly. Unless you're managing $50, $100 million plus, you can buy most stocks in a second with a market order on E-Trade or Fidelity and get out just as quickly. Big Wall Street funds do not have that same luxury. Since when they are buying, they're buying tens or hundreds of millions of shares, it generally takes them weeks or months to build those big positions in the stock. Most estimates say that Warren Buffett spent about 2 months building his position in Apple, which is one of the most liquid stocks in the world. So what this pattern is doing is identifying these stocks being bought by institutions, visualizing when they are building those positions, and then identifying the place where you can buy where the law of supply and demand are working in your favor. Okay, so let's just walk through what's going on here. First of all, the stock's got to be moving. Right, in the case of NVIDIA here, if we look over here on the left side, between April and August, so about a 4-month period over here, this stock went up 80%. Okay, that's a big move, especially for a trillion-dollar company. So when you see a stock up 50, 80, 100, 200%, that shows you it is in play. It shows you it is actively being bought by these big firms. That's good. That's what we want. We want to be on the same side as them. But as the stock begins to run away, and as it makes big moves, two things are going to happen. Number one, some people are going to begin to take profits, right? You bought the stock at 20, it's at 50, you've doubled your money. You want to cash out. You're also going to have these big funds who are actively trying to buy the stock and don't want it to get too high. They're trying to buy millions and millions of shares. They're trying to do so as cheaply as possible. So they'll often manipulate the news. They'll put out a story about why NVIDIA is overvalued or why their earnings could soon crater or why we think the stock could fall 50%. All that doom and gloom nonsense is just done to try to manipulate the average investor, pull the stock price down so they can keep buying. But for whatever reason, when that stock finally pulls back, if these institutions are indeed actively buying the stock, day after day, week after week, they're going to take advantage of that. It was at 50, now it's at 40, let's buy, and you'll notice they very quickly drive the stock price up. Again, you're going to have some profit taking, both from short-term traders as well as people who saw it go up to 50, come crashing back down. Oh, it's back at 50. I've got to get out, right? And they do a little more selling and it pushes back again. Once again, the institutions buying the stock up, drive it higher. And then you'll see how the chart just gets tighter and tighter and tighter. It shallows. The pullbacks get narrower and narrower. And what's happening during this, what's happening in this structure is the stock is becoming harder to buy, right? We think of stock in terms of like this infinite demand. I can buy as much as I want, but that's just not the case. There's only so many shares out there for any given company. And a lot of those shares are sitting in index funds, are sitting in retirement funds. They're not out there offered for sale. So you're only dealing with what's known as the float. How many shares are currently out there trading? And so they've bought a bunch in here, they bought in here, they bought in here. And the fact that it's getting shallower and shallower is showing there's fewer and fewer shares available to buy. The stock is becoming harder to buy. They've sucked up as much stock. They've bought as much as they can in this kind of $40, $45, $50 range. And so what's happening is the stock is transferring from the weak hands to the strong hands, as they say. Right? The weak hands are people like me and you, anybody who's going to dump it if it falls 10, 20, 30%. The strong hands are, the New York City pension fund who's buying this up. It's 5% of their portfolio. They're going to buy it and buy it and buy it. They have no stop loss, et cetera. And so those people are not going to get shaken out. And so when this happens, when they've absorbed all the supply they can, they've bought up as much stock as they can, the kind of $40, $45, $50 range. Well, now if they want more, and of course they do, they got to pay up. No one else will sell it at $48, $49, $50. Well, would you take 52? Would you take 55, 58, 60? So they have to chase higher prices. That's what causes stocks to go up. And so what you are doing with this pattern, number one, you're finding stocks being purchased by big funds. I mean, it's clearly a big mover. The thing is doubled from May to January here, from 25 to 50. You've allowed the stock to compress and tighten and shallow as the market has absorbed its supply. All the big buyers have sucked up all the stock they can from the sellers. And then now you have the same amount of buying, the same amount of demand, but less supply. The same number of people trying to buy the stock, but there's not much out there for sale. And so when you have a lot of people trying to buy something and not many of those units for sale, that's what caused the price to go up, supply and demand. Same thing that happened to housing in 2020, et cetera. And so buying here allowed you to get in right there at the most explosive phase, and the stock went rallying higher for about a year, year and a half. And this pattern is going to show up over and over again. Here's a trade we took on Dreamfinder Homes with our members, DFH. Now, not as explosive as NVIDIA, but for a home building stock, this is a pretty strong move out of there. And you're seeing the same thing. The stock initially comes off the lows here in early 2023, rallies 60% in just over a month. That's a pretty big move. Once again, you get the profit taking. They drive it back up, shallower, drive it back up, shallower, drive it back up. And you can very clearly see this resistance level here at around 13.5. Now, another thing I've done, I've marked up the percentages on this chart, and that just shows how much the stock fell here from high to low. So this is a 20% dip, an 11% dip, a 6% dip, and all things being equal, I want to see these getting shallower and shallower, ideally being cut in half each time. In 95% of the stocks I buy, this last little tightening is going to be sub 10%. And the reason I like it to get really tight like that is, one, it's showing me that the stock is very much hard to buy and it could explode very quickly. But the second thing is, now I don't have to risk a lot of money. What you're noticing about these is after it dipped down to 20% here and then started rallying higher, well, it didn't come back here. The next little pullback only went down to here at about 1140, rallied back up. The next one only came down here to about 1250 and rallied back up. So since we know these are getting shallower and shallower and shallower, we know it should not break below. Where's my stop loss? at what price, if I buy it here, okay, if I buy the stock right here at whatever that is, $13.75, I don't have to risk a lot of money. Where, if the stock falls down to here, okay, this line I've drawn to last little, what I call the swing low, right here, about $12 and call it 40 cents. It shouldn't go below there. So I know that if it does, I am wrong. Something has changed. The stock is no longer in demand. I didn't map it right. We hit a bear market. Something is wrong. So I will automatically sell if it falls down here. And so what that means is I'm buying here at, call it $13.45. I'm going to sell if it falls down here to about $12.50. I'm only risking that 6 or 7%. And on a 6 or 7% risk, I'm still able to make 94% over the next 2.5 months. And this is really the name of the game, right? Whether I don't care what your strategy is, you always want to be risking much less than you're making. Yes, it's about how often you're right and how often you're wrong, but it's more importantly about how much you make when you're right and how much you lose when you're wrong. Because make no mistake, you're going to lose some. Sometimes you're going to be wrong. Warren Buffett is not right 100% of the time. Warren Buffett's not right 70% of the time. The best traders in the world are right maybe 60, 65. And so you really need to have that line in the sand that says, here's where I'm out. Here's where I'm wrong. And if you're in a habit of losing 5, 6, 7% when you're wrong and making 40 and 50 and 90 when you're right, you're going to have a very good time in the markets. Okay, here's another one, Riot Blockchain. Now, this one, again, you see back here, when was this? 2020. Okay, this stock was a big mover. I mean, 800% in 5 months. It then, of course, pulled back, which is going to happen eventually when these stocks make big moves. And notice it shallows and shallows and shallows. Now, this one didn't get down to that sub 10% level I like. When you're looking at stocks that are up 700-800% in a couple of months, they don't always get that tight. But notice here, same pattern, same shallowing, same resistance. It breaks through that kind of $4.50 mark. You buy, and this thing is just off to the races. Exploded higher. You bought this thing at $4 a share in November. 3 months later, you're up 2,000%. You get one of these a year, one of these a decade, it's really going to move the needle. Here's MLTX. This one was a big, big pattern. I don't usually like them this big. This is like 8 or 9 months. But as you can see here, this stock was a SPAC. Those things that were all hot back in 2022, goes public at 10, jumps 40% in a couple of days, then gets absolutely murdered. Falls 70% in a week. It's got to recover from that. It carves out this shallowing pattern, rounds out, breaks out here above $10, and as you can see, just accelerated almost immediately after coming through this area. Here's another one on Mohawk Industries. And this pattern not only is going to work well at the highs, but it is without a doubt my favorite thing to look for coming off the lows. So after a bear market like we got in 2020, in 2022, in the first quarter of 2025, where a lot of these big growth stocks take the brunt of the dip, you'll see the same pattern forming as the stock comes off the low. Here in Mohawk, you see that shallowing. Last pullback about 6%. Very clear resistance. The stock cannot get above kind of $86, $87. It does on a spike in volume. You buy, and it accelerates. Same thing with OKLO. Notice again, it's not as it is coming out of nowhere. I mean, this stock was up 400% in 8 weeks. Clearly, it's being actively bought. Clearly, it's a big mover. So instead of just chasing this stock, jumping in, YOLOing, and cross your fingers like most morons do, you wait until it puts in this pattern. You wait until it absorbs that supply and you have some kind of an edge. And while it did come back just a little bit here, remember your stop loss would be just below that last swing low. So this is a bit of a more volatile one. You're buying here. Your stop loss is just down there beneath the low. So this was like a 20% risk. May or may not have taken this, but it never hit your stop loss, and then it just surged 130%. Now what happened next? Well, the trade war. Trump kind of declared economic war on the entire world. Everything came down and came shocking down. But again, and this is one of my best trades here of May, look what happened down here off the lows. You got the same thing as it comes down and tightens and tightens. I want to say I bought this stock here at 26. It may have been a couple days later at 27, but either way, it just explodes higher, nearly tripled over the next 48 days. SMR, bought this one as well, same exact pattern. You see here, it happened near the highs. Okay. I didn't draw this very well, but you get the idea, right? Shallowing, breaks out. And we notified our members of this one. Came out at 14, runs to 32. Again, 2025, tariff war, everything gets hammered, forms the exact same pattern. You buy it the second it comes out here, and it's just an absolute monster. You'd be up 147%. I think I sold this one, I don't know, right around in here maybe, something like that. QUBT, same thing. Big quantum stock, hammer to the tariff war, tightens up, shallows, breaks out, and runs higher. Now, the biggest ones, and I want to show you this before we go, if you're looking for stocks you can hold or commodities you can hold for months, years, what you want to see is this exact same pattern setting up on bigger time frames. So this is a chart of gold prices as of early 2024, and I want you to see this. So here you can see that pattern, I've shown you over the last 10 minutes or so, right? Comes in, shallows up, got a little sloppy over here, but comes right back, tightens up. And very clearly, resistance is at around $2,000 an ounce. Little wiggle there, but I mean, Helen Keller could spot this stuff, right? Clearly, you want to buy when it breaks out above. But let's step back a second. Let's go back and look at this on a weekly chart. So I'm just going to back out. Notice the scale on the bottom, okay? If we go to a weekly chart, we're going to look at a much bigger time frame. Little PSA for everyone. If you like energy drinks, try the orange Red Bull, okay? Strawberry apricot, best there is. And for those of you saying energy drinks are not good for you, I know. I also have a 3-year-old daughter who wakes me up about 4 a.m. every day, and I don't like coffee, so it is what it is. She's adorable. Plus, she does this every morning before I leave. But anyway, back to the chart. So here we're on a weekly chart. So notice the bottom. Now we're looking at about 5 years, from 2020 through mid-2024. And on this much larger time frame, we're seeing the exact same thing. I'll change this to a different color here. Make this one yellow. I'll kind of move it just barely so you can see. But notice here, same thing. Big move, big shallowing pattern here, going over about a 5-year period. And then the icing on the cake for this one, we're going to step way, way, way out and look at this as a monthly chart. Each one of these bars is just a month. So this is covering about 25 years of data. And again, we are seeing this very same pattern play out, bigger picture here, as the stock, after the big run up in the early 2000 to 2010s, forms this basically 15-year breakout pattern here on the monthly chart. So it's setting up on a monthly. It's setting up here on the weekly. It's setting up here on the daily. What do you think you should probably do when gold gets out above $2,000, $2,100 an ounce? I held webinars for my members on a Saturday in February 2024 saying, this is why I think you need to buy gold. And if we look at what's happened since then, shocker, it's up big. It didn't pause. It didn't wait a few months to run. It immediately began to push higher. And gold from there is currently up about 60% over the last year and a half. And if you're a student of gold, it's a pretty big move. So this is my go-to breakout strategy. It is a simple, repeatable pattern And it forms based on the law of supply and demand. It's common sense. Remember what I said. Stocks go up and down based on whether institutions are buying and selling. It doesn't matter if they're right or wrong. It doesn't matter if they're buying Nvidia stock or Beanie Baby futures. If Goldman Sachs and BlackRock and Credit Suisse and the Fidelity Magellan Fund and the Notre Dame Endowment Fund and all these mantras, if they're all buying anything, it is going to go higher. So as an investor, as a trader, instead of trying to be right, instead of trying to guess or speculate or outsmart Wall Street, shift your focus to simply trying to interpret. Interpret what they're buying. Interpret where you have an edge. And if you do that, I can almost guarantee you will see better results.